What is considered a good cap rate in real estate? Cap rate is short for capitalization rate. It's basically used to estimate the rates of return on real estate properties, mainly commercial real estate, but can be used for residential. Cap rate is calculated by dividing the property's net operating income from its market value, mainly at the time of purchase. Cap rate is the quickest way to determine whether a real estate property is a good investment, justifying any risk involved. Net operating income is any income coming in minus expenses. You don't include down payments or mortgage in your NOI. You divide NOI by the market value of the property. Some real estate investors will either choose the price they bought the property or the current market value of the property. I personally use the price I bought the property since it gives a realistic picture of how much I'm getting in return for my investment. After you divided the two metrics, you convert it into a percentage, and that's your cap rate. For example, let's say you buy a house for $300,000 and rent it out for $2,500 per month, minus other expenses of $500 per month, $24,000 per year. $24,000 NOI divided by $300,000 equals 0.08, or 8%. We have a cap rate of 8%. But is that a good cap rate? What's considered a good cap rate? The higher the cap rate, the higher your return. In general, a cap rate around 7 or 8% is considered a good cap rate. But cap rate doesn't tell the whole story. Lower cap rates are less lucrative, but they're considered safer investments. Higher cap rates bring in a higher return on investment, but some risk because you probably got that property at such a low price. The cap rate is a quick way to compare investment properties. Everyone has a different ideal cap rate based on what they expect and the risks involved. Let's compare investment properties to see which is a better investment for you. Property A was purchased for $450,000. Property B was purchased for $250,000. Property A has an NOI of $2,200. Property B has an NOI of $1,250. Annualize both property NOIs and you get A, $26,400 and B, $15,000. This is property A and this is property B. Property A's cap rate is 5.8% and property B's cap rate is 6%. This tells us that property B is a slightly better investment based on solely the cap rate. But the downside of cap rate is that it only gives us a simple calculation and other factors may need to be included. NOI is an estimation because you'll never know if you can get a tenant at that rent price or what the vacancy rate is. Cap rate is a useful tool, but it shouldn't be the only tool when analyzing an investment. So what are your thoughts? What's your ideal cap rate? Comment below. And as always, take care of your money.